with anybody else, you would be charged with what? Embezzlement of company's funds, right? But I'm selling it right now to the owner. Let's take a bookkeeping entry. Debit, cash, right? Credit, building. How much cash did I receive? 7. How much was the building? 10. You know, accounting is a fun thing. You always know that debit equals to credit. So we need to debit something. How much? 3. Splendid. Now what is this 3 going to be? That is going to be drawings or, well, type of dividends, right? So where is going to be the bookkeeping entry going? You go to the retained earnings, right? So we are going to charge it to the retained earnings. Good. Also, it was a sales transactions, but no revenue was generated, right? Why? Because I done it with my owner. Okay, let's go to the second example. Now let's assume that we do it vice versa. Okay, let's do it vice versa. Let's assume that now I have an entity. And the entity has 6 cash. And here is the owner who has a building which has a building with the fair value of 10. Right? So the fair value of the building is going to be 10. Now the owner will sell to the entity. What is going to be the bookkeeping entry? Well, first of all, the entity needs to record the amount. Need to record the building. How much did they pay for it? 6. It would be very misleading to record this building at the value of 6. How much I paid for it? Because this was not a real transaction. I made it with who? With my owner. And you remember, what is the rule if I'm doing any kind of transaction with my owner? Must be written like in the book of the owner. So close to the fair value, right? So let's do the fair value then. Debit building. How much did I pay? 10. Credit cash. How much did I pay? 6. So I need to credit something. What am I going to credit? Correct. It's going to be equity. Again, so no income, nothing. Why? Because I've done my deal with who? With my owner. Okay, what line in equity are you going to credit? No, retained earnings. That's the only rule. Okay, so it shouldn't be retained earnings. Why? Because what is retained earnings? Retained earnings is basically it's a distributable part of the treasure chest, right? You put from above the profit inside, and what are you taking out? The dividends. But this is not profit. This is not profit. Usually what we do, we open a new line in equity, what we call how? Transactions with the shareholders or other equity. This equity is very close to what? It's like capital, like share premium, right? It's very close to share premium. Usually we put it to other equity, all right? There is one more thing I would like to point out very quickly. Let's assume I am a shareholder of a huge telecommunication company, all right? I'm a shareholder of a huge telecommunication company, and at the same time, I entered into a contract with this telecommunication company, and I purchased a mobile subscription, all right? Now, I am dialing on my mobile phone, so I make revenue to the company. I am owner with, right? And who actually provided me this telephone. Question, is this going to be a revenue or not? Because remember, everything must be excluded from income, thus included from revenue, which is a transaction with my owner. Hold on for a second. Am I going to exclude this? All of you do this, but why? You're right, actually, but why? Because it doesn't make sense, right? Yeah, but why doesn't it make sense? Huh? Yeah, but what's the rule? Actually, what you guys are saying are all okay, but the real reason is because of this. In order to exclude something from the revenue, you must have a transaction with the owner. Is that true? Yes. And now comes the next part. In the capacity of the owner. And in this situation, the deal was not in the capacity of the owner. So, why did I tell you all this? The reason I told you all this, because this rule remains. And actually, it became a lot more clear that if you make a deal with your owner in the capacity of the owner, that's not going to be in the scope of IFRS 15. Okay? Remember this? That's important. Yeah.
Plus, is there any guidance on when you treat the contribution as the owner of the...
Yes, it's how do you distinguish? I mean, can you decide who is your owner? Yes. What is incapacity? Okay, I tell you what we usually do. You check if you would do it with anybody else. Because if you would do it with anybody else with no problem, that's not an owner transaction. But if you only do this because you kind of say that I wouldn't do it with anybody else but with the owner, like remember my previous example, when I sold the building at a lower price, if you do it with anybody else, you are going to end up there, in a jail, right? Embezzlement of companies' funds. Okay? No, I didn't say that. I did say that you wouldn't do it with anybody else. Let me tell you another example. I have only one main asset that produces something. Would you sell it to anybody? Because then your company is gone, right? Even on fair value, you wouldn't sell it to anybody? I mean, if I want to be a going concern, heck no, right? Therefore, even this one is going to be an owner's transaction, so you wouldn't do it with anybody else.
Yeah, now let's look at the other scenario you mentioned where the owners actually
Yeah, when it's contributing.
Now, I'm going to use that as an office building, but I have a choice of getting it from the owner, or I could go to somebody else, but I still prefer the owner.
Yeah, that one is not going to be that's not going to be an owner's transaction. In order to have an owner's transaction, what you need also that some type of fair valuation, what you mentioned, needs to be taken into consideration. So if you only chose the owner because you prefer to do it with the owner, but at the end of the day, more or less you've done it on normal terms, that is not going to be an owner's transaction. So it must be with the owner and in the capacity of the owner, and this one is the important one, in the capacity. Okay? So would you do it with anybody else? Right?
Just sorry,
yeah.
Anything going with is generally also covered by the company law or commercial law?
Yeah, everything what is going into equity will be covered by the legal legislation here. Yeah.
So now we have a situation where I'm entering into a transaction with the owner, but the commercial law doesn't support that. Then what happens? So what is,
Okay, now there is one very important thing. At this part of the world, you guys never ask me about taxes. Obviously, because you don't have those. Actually, you know what? That's the same question when you go to Europe or the United States and they keep asking you about taxes. What is the answer of IFRS? That's a different issue, right? So, for taxation purposes or for legal purposes, statutory purposes, what you're asking, you need to check the company law. And IFRS will not have a guidance on it. So, in this case, if you have this other equity line, and you have to be able to somehow present it according to your company law, you need to file legal way. Most probably you are going to treat it together with what? With retained earnings. But be careful, from accounting perspective, that's totally a false idea to show it together with retained earnings. Why? Because retained earnings is the treasure chest. You put from above inside the profit and you take out the dividend. Can you take this out as a dividend? Right? Retained earnings is generated, and this one was introduced. Okay? Yeah, let's go further. Let's see the other things that we need to deal with, the other scope and scope exceptions. Yeah. Yeah. Of course, this one will be reclassified to retained earnings. So, but that's only a reclassification issue. That's going to be only a reclassification issue. So what you will do, you transfer from the other equity to the retained earnings, or you just keep it there. It's up to you. There is no prescription for that. The important part is that you cannot actually distribute that. That's it. All right? Now, contract with customer is partly within the scope of other standards. Okay, so this is the situation when you have a contract. Half of it is financial instrument, half of it is not financial instrument. What are you going to do? Which standard will apply? Please remember this rule, because this rule is important. This can come up very often. So when you have bundled together a financial instrument and something what is, let's say, under IFRS 15. Now, what you do, IFRS 15 is telling you that the other standard should apply first. Okay? So first you need to apply the other standard in order to be able to separate. And if there is no guidance in the other standard, then you do the standard only. Alright? So first you are applying the other standard. IFRS 15 is only coming after that. Okay. Now, what we were talking about now? We were talking about the definition, and we were talking about what is under the scope and what is not under the scope. What was under the scope? Customer contracts, right? And we actually listed what is included in here. Now, after this, we go to the summary of the basic steps of the model. No, fine. We already done half of it, right? Now, we already did the 5%. This is 90%. Okay, this is 90%. The third step is 90%. Okay? Look over here. That's the summary of the model. The summary of the model is telling us that recognize revenue to depict the transfer of the goods or services to customer in an amount that reflects the consideration to which the entity, you see again it's bold, expects to be entitled in exchange for those goods or services. So that's the rule I already told you. And now comes the fun part. IFRS 15 includes a 5-step approach. And this 5-step approach is going to explain you how to account for the revenue. Very important. These steps are strictly after each other. So you cannot mix them up. First you have to identify the contracts with the customer. That's the first thing that you have. So what is that? You decide if there is a contract or not. Because if there is no contract, the IFRS 15 cannot be applied. Okay? Then you identify the performance obligations. Then you determine the transaction price. Then you allocate the transaction price to the performance obligation. And then you recognize the revenue. And hold on. When or as the entity satisfies a performance obligation. Hold on for a second. Then what is that? Point in time. What is as? Well, over a period. Over the time. Hold on for a second. What was point in time in IAS 18? Selling goods. What was over the time? Construction contracts and certain services. Right? And certain services. Now what we are going to do over here, this is actually going to be one of the trickiest steps. That they merged the two together. Because the first four is pretty obvious. The fifth one is actually going to be the part when you are going to decide if I can recognize revenue as I'm working, or I have to wait until a certain point. Now let's go step by step. The first step is identify the contract with the customer. Hold on. The contract is defined as an agreement between two or more parties which could be written, oral, or even implied. Okay? Good. Does not exist if both parties can cancel without penalty. Okay, that two rules are extremely important, and that is more important than the first one. Does not exist if both parties can cancel without a penalty. What does this mean? If I can withdraw from the contract without hurting myself seriously, then it means revenue may be not recognized, even if I started working. Yes, even if only one party can cancel. Now, if one party can cancel, it means that I have the contract, because in order not to have the contract, it must be both parties, right, who can cancel. That's the first one. Contract must exist. Also, there are some criteria, so that's an addition. Contract has to have a commercial substance and the parties are committed to perform. Okay? So it must have a commercial substance, so it has to, some party has to provide something and the other party needs to give something in exchange. Parties can be identified, can identify the rights in the contract. What does this mean? I know what I need to do. Right? I know what I need to do. That's the next one. So the contract must be clear, right? What needs to be performed. And payment terms can be identified and collection is probable. Now hold on for a second. That's again a very important issue. Collection is probable. Can it happen that I make a contract and later it will turn out that they are not going to pay it? Can it happen? Yes, it happens quite a lot, right? Now, do I record the revenue? Yes, I still record the revenue. Only what am I going to do with it? I am going to write it off. That's an impairment issue, right? That's a credit loss. Wait for it, it comes in the afternoon, all right? Hold on. But if in the beginning I know that it's not going to be paid, or I'm not sure if it's going to pay, do I record the revenue? No, but only if I know it when? At the very beginning. Let me give you an example on that. Okay, let me give you an example on that. Let's assume that you are in the United States and you get sick and you are rushed to hospital. Do they need to, I mean, you know, there you have to pay for medical treatment, right? I mean, you are bleeding and your head is half cut off. Are they going to have to, you know, deal with you? Yeah. Or they ask you for the papers, right? Do they have to deal with you? No, law requires you to. Law requires them to deal with you. Are they going to be able to record the revenue according to IFRS 15? What do you think? Do they have a contract? No, because it's only required by law. So when are they going to be able to start recognizing revenue? When they know that it's going to be probable that they are going to collect it. Because what's the difference between not paying and this one? This one I know when? At the start. That's the difference. That's the difference. Okay? Now, let's go through. You had a question?
I'm just going to buy a bottle of milk from a local supermarket. Okay, if you ask me whether there's no written contract, but basically say there's an oral or implied.
Okay, let me ask you a question. You don't have public transportation. I mean, I don't know what type of public transportation do you have over here, but I assume it's not that very well developed currently, right? Okay. But for instance, if you go to Europe, we have public transportation every day. Okay, I have to tell you something. I have a dark secret. I'm a lawyer. Okay? So I went to law school. So basically these things we studied a lot. How are you going to have a contract for public transportation? Do you go to the public transportation office and you say that, hi, I want to go from that side of the city to that side of the city. Can you please print out the contract? And no, what are you going to do? You're going to go on and take the bus. Did you make a contract? Yes, you did. That is called implied. Right? Implied contract means that you are going to be doing, you are going to fulfill your obligations, and you didn't actually say it, you didn't actually write it down, you just did what? You just acted like it. You just acted like it. But hold on for a second, that was a very extreme example, right? So let me go for a more, how shall I put it, more business-like situation. I don't know if you have these type of things over here, but what about returns in retail? Can you return the goods to the retailer if you don't like it? After 2 days? Well, it depends, right? Maybe law is going to require you to do that. Or maybe the company is just going to take it anyways, right? Now, I have tell you what is the rule in our country. In the country where I'm coming from, you can take back the goods for 35 days, I think, I don't remember now, but most of the shops are taking the returns, unless the goods are damaged, for 1.5 months, which is obviously 45 days. What? Management decision? Do they write it down? Do they say it to you? No, it's just a common practice.
No, but if there is a legal requirement...
There is no legal requirement to take it back after the 30th day.
No, but I think here, we have some, I'm not sure if it's speaking correctly, but I think if you go to the supermarket and then you have a right to return within 7 days. Yeah? So do they...
but this is a constructive obligation. So that's also a contract.
So do you delay it till 7 days?
The revenue recognition, we are going to talk about the right of return. At the end of the day, that's going to be a big no-no. Alright, you're not delaying it, but you are going to build a... something like that. Okay, but the right of return is going to come, don't worry. But what I was talking about, do they have a contract to take it back for 45 days? Yes, they do. Because that's implied contract. Because that's a common business practice. Right? Okay.
One other small one.
Yeah.
There's a contract with the customer. The
Yeah.
price is probable, but the price is not certain.
The price is not certain. Okay, that's also one very important thing. If you can somehow judge the price, make a judgment, and make a reasonable judgment how much is the price is going to be. Hold on for a second. What did you do currently if you didn't know the price exactly? You deferred it until when? Basically until you received it. Right? Now that's change. You remember what I was telling you? I was telling you that actually one of the biggest change in the standard is that variable consideration, which also is a certain consideration, is going to be included in the price. So therefore, are you going to delay it? No, we are going to have specific rules how to calculate them. What are going to be the specific rules? Make your judgment and see how probable is that. You will see that the rule regarding this revenue recognition is pretty weird. But we are going to get there, you will see. Even if the price is not sure, if you can make a judgment, you have a contract. Okay? Good. Okay. Now, multiple contracts entered into at the same time with the same customer should be combined if certain things are met. So there is going to be a very, very detailed regulation when to treat the contracts as one and when to take them apart. Okay? About this, we are going to talk about in a minute. Now, so identifying the contract, and let's see when do we need to combine them. Contracts entered into at or near the same time with the same customer should be combined. Look, not a choice, should be combined. So that's kind of a rule, all right? If any of the following criteria met. All right, let's try to translate it from English to English. They were negotiated as a package with a single commercial objective. As a package with a single commercial objective. What is that? How do we call this in real life? What is the name of this deal? Package deal, right? What does it mean? What does a package deal mean? You cannot accept only parts of it. Either you take it like this, or you take none. So if something is a package deal, that is one contract. Even though that sometimes I may be having several written contracts at the same time. Yes, but for accounting purpose, it must be treated as the same way. All right? Okay, let's see the next one. Consideration to be paid in one contract depends on the price or performance of the other contract. Okay, let me tell you an example of this. Okay? I am giving you this service, okay? And if I do this service good, or you are taking that service, I will give you the additional service for a very little price. Sometimes you do the following things. I sell you the goods for $1 million, and I promise that for $5 I will give you a warranty for a year. How many contracts do I have legally? 2. How many contracts is that? 1. Why? Because the only reason I gave the next one for 5 is because I already made my profit on what? On the first one, right? So I will need to reshuffle the price, okay, for accounting purposes. So when the price of the second one is not independent, all right? And let's see the last one. Some or all of the goods or services promised in the contracts are a single performance obligation. That one looks weird, but let me explain you what do I mean by that. Actually, this happened 1 week ago. We had a client who is building shopping malls. Well, not shopping malls, but in Europe it's very common that we put the grocery stores, huge grocery stores, out in the desert, so in the middle of nowhere. So why? Land is cheap, right? Land is cheap there. And if you want to build a grocery store in the middle of the city, nobody is going to buy there anything. Why? Because for a liter of milk you are going to pay $100. Why? Because otherwise they won't be able to pay the rent. So therefore, in order to have grocery stores, we usually have to travel 20 kilometers from the city. Okay, it's very fun, really. So what they do, they usually build it next to what? Highway. No? I mean, otherwise it wouldn't make any sense. They put it over here to the highway. What's the problem? There's the highway, there's the shop. Oh, you need a bypass road. Okay. Now, how many contracts are you going to have? 2. However, the shop without the bypass road, I mean, what, you walk, right? So, in this situation, even though I have 2 contracts, legally, I will have how many contracts? 1, because the shop cannot be used without the bypass road. Okay? So this is the third one. In these cases, hold on for a second, what did I tell you? You should combine the contracts, which means that that's not a choice. That's a must. Now, okay, this is also very important. Contracts may be combined into a portfolio with similar characteristics if the entity reasonably expects the effect on the financial statement would not materially differ. Okay, this is for those who are regularly selling the same thing to different customers, and the customers are basically behaving the same. What is this rule telling you? That's actually a practical expedient. Why is it a practical expedient? Because they are telling you that, okay, if you have more or less the same customers, and if you have a lot of contracts at the same time, you can treat them how? As if they were one contract, because at the end of the day they will balance each other out. Okay. Now, contract modification. Now, the contract modification is going to be a problematic part. The contract modification is actually 2 types. The contract modification is actually a modification or an entirely new contract, depending on what is going to be happening. Now, let's see. If only the price is changing, then we just need to reallocate. That's not going to be a new contract. But treat as a separate contract if the following is going to happen. We add the separate performance obligation. Hold on for a second. What do we mean by that? Add the separate performance obligation. We modify the contract, but actually we give an additional thing, right? And or actually because, and consideration reflects the standalone selling price. Let me give you now another example of this. Shop, highway, bypass road. Bypass road and shop is one contract. But now I decide later that I will add a pedestrian walkway, which is negotiated later, okay? The shop can be used only with the bypass road, but now I'm adding an extra feature, a road. Is it going to be a separate